We really like the setup for Indian financials, particularly starting from last month when we upgraded the sector, literally right after the Liberation Day announced by the US president. I think a couple of reasons why we started to turn more constructive after not being so positive on the space for the last 2 to 3 years. There are a couple of reasons for that. The number one reason is the bottoming out of the NPL concerns. So we believe that we are perhaps at the fag end of the NPL cycle that the Indian financials witnessed, emanating essentially in the unsecured loans. In addition to that, we believe that the profitability will start to bottom out in the next 1 or 2 quarters. There has been one important change that has happened in the space over the last couple of months, and that is that the regulators have started to support the sector. You've seen a slew of reform measures or the supportive measures taken by the Reserve Bank of India over the last couple of months, importantly around the liquidity. And that's, again, being supported by inflation being under control. That is a great news for the financial space because for the last 1.5 years, we had tighter liquidity conditions prevailing in the system. So clearly these two things would mean that the EPS cuts would start to bottom out. And the fourth quarter results actually validated our thesis to a large degree, wherein we see some of the large lenders report earnings beat. And that led to the revisions of the earnings for those lenders.
There is a wild card in the pack, though, isn't there? And that is credit growth. I know you're watching that closely, given the prospects for slower growth in this tariff environment broadly. What's been priced in, Rahul? What are the tail risk events in the consumer and business credit cycle that you're watching that could upend what is, as you say, a positive earnings growth story?
Certainly. So look, credit growth is naturally going to be slower in this period. For a couple of reasons. Number one, the household balance sheets are still being repaired. And I think the confidence would start to emerge perhaps in the second half as we wait to see what the measures of the government of India's tax cuts do to the households. So you will recall in the last union budget, the government announced the income tax cuts for the households. That's a stimulus to the extent of about 1.2 trillion INR. Worth of tax cuts being given out to the households. Number one. Number two, the households are consolidating the balance sheets as well. We have seen the decline in the origination volumes for some of the loan segments such as mortgages, etc. So we are in a phase of consolidation, which is a healthy sign after having seen heady growth over the last 2 to 3 years, which made even the Reserve Bank of India concerned, and that led to the increase in risk weights on those loans.
Can I raise this with you, Rahul? We've been hearing a lot about a brewing household debt crisis among India's middle class. Is that an overblown risk or is that a real risk?
Clearly, it was a real risk. Goldman started talking about it back in June 23, and then we saw Reserve Bank of India took the right measures of warning the system by raising the risk weights on these unsecured loans, and that led to a slowdown in the unsecured lending for the households. I think now we've got to a stage where the households are consolidating their debt. The government of India has given them the tax cuts. And the interest rates would also reduce the EMI burden, or particularly on the mortgage loans, which will also add to the disposable income. So clearly, we are in the middle of the consolidation phase, which should lead to a pickup in the later part of the year and perhaps in the second year. But that is definitely a real risk, a joker in the pack, as you rightly said. But we believe that we'll still be okay at 10 to 12% credit growth. And just one last point to make here, it is also supported by a healthy real GDP growth of north of 6% in India, leading to a normal GDP growth of, let's say, about between 9 to 10%. So on the back of normal GDP growth of 9 to 10, a 10 to 12% credit growth is something that the system can witness over the next couple of quarters.
If we pop the hood, so to speak, on the underlying economy, what are the credit spreads telling us about where we are in the cycle, and are they flashing any warning signs?
In fact, I would say that there are no major red flags after this recent unsecured cycle that the system has managed to handle. The credit spreads clearly are being benign, whichever way you see it, be it on the interest rate side as well as the risk indicators. We track some of the bureau data quite closely to see whether there are any major risks building up in the trenches. And I feel that, the red flag concern is by and large behind us. Having said that, Of course, there are risks as we talk about on the global side. We all know the potential slowdown of the global GDP emerging from the tariff concern that are going on in the global economy. And while India, on a direct basis, will still be able to manage it better, relatively speaking, to many other economies, there is always going to be indirect risk because of the reliance of the services sector, particularly the GCCs in the IT-enabled sector, on the US economy and the global economy. But having said that, we believe that the improvement that we are seeing in the household space should be able to absorb it and manage to overcome any potential risks.
Especially now that the RBI has embarked on what appears to be an easing cycle. Where is that leaving margins, though, and what outlook do you have for the major banks?
Absolutely. So look, Indian banks had a Goldilocks period when the rates were going up. They witnessed massive margin expansion. Now, of course, our house view is that the RBI will cut rates by about 100 basis points. A majority of should be reflected in the first half of the financial year, which is by September of 2025. Thereafter, we should see some benefits starting to come through. So in the initial phase, the repo rate cut will lead to a drop in the yields on loans for the banking system or the financial system. Thereafter, the cut in deposit rates and the improvement in the funding cost due to the liquidity surplus in the system should allow support to the margins in the second half. So we feel that by first half, most of the NIM compression should be by and large done with. And thereafter, we should see improvement in the margins driven by the reduction of the deposit rates, though competitive intensity could remain a legit risk in the later part of the year.